In market news now, Asian markets were mixed after U.S. Federal Reserve Chairman Jerome Powell forecast more rate hikes this year, saying that the process of getting back down to 2% has a long way to go. Global shares eased as a result, while the dollar held steady against the pound ahead of the Bank of England's decision on monetary policy. And with news just in on that monetary policy announcement, the Bank of England deciding to hike by 50 basis points, much higher than the consensus expectations, indicating that the Bank of England is worried about the dynamics of price increases, in particular the service sector inflation. And just to mention there that we had 2 of the 9 MPC members voting for a 25 basis point hike. That's news just in. And the contention right now is how big the raise will be after inflation data came in higher than expected, with analysts saying that we could see rates going to 6%. And the question has been, at least for over the past week, what does that mean for Rishi Sunak's plans to grow the economy, with some analysts saying that we could see the UK economy drop below 2%, at least when it comes to its GDP target. Meanwhile, retailer Mr. Price posted a fall of 6% in annual profit as interest rate hikes dampened consumer spending, and the impact of load shedding costed about 1 billion rand in revenue. Despite opening new stores over the past year, Mr. Price has pulled back on some budgeted store openings in the new financial year because of a lack of good trading locations. And a conference call with Investors CEO Mark Blair had this to say about the group's market share.
I think for us, getting reads on market shares is obviously becoming a little bit more cloudy with all the movement that's happened in the market. So let's just start off with Stats SA, and this is type D retailers. Our market share increased by 70 basis points, and quite notably, and why Stats SA is important, is that it's the chain that actually, it's the reference point that includes all our trading divisions. The RLC market share was down 110 basis points, mainly due to the homewares performance. But just don't forget that RLC doesn't include all our divisions. It doesn't include Mr. Price Sport or the Studio 88 group, because there's no RLC for that, and competitors won't include their information either. Under market share, I think it's also quite important to point out that we are after sustainable, profitable market share. As I said before, we've got an EDLP model, and it means everyday low prices, supported by promotions occasionally and in specific categories. And we're after profitable market share gains, not market share gains at all cost. Mark spoke about what's happening on the storefront a little bit earlier. And just really looking at what our goals and our targets are there. We've got the appetite for it. We say that we're going to plan to open about 130 stores per annum, excluding our acquisitions. And acquisitions, I'm including all 3 in those. And there you can see the approximate split. So whether you're talking apparel or homeware chains, and even if homeware is under a bit of pressure performance-wise, we're still investing in those chains because there's still definite, A, we're getting the returns, and B, there's more locations we can go to.
To talk to us about the latest when it comes to market developments, we're joined by Patrice Raso, who's the Chief Investment Officer at Ashburton Investments. Patrice, we're going to start off with Mr. Price right off the bat, indicating here that they were conservative when it came to their backup investment, but also they've got this uphill battle to try and deal with their higher inventory levels. What did you make of Mr. Price's results?
Yes. Good afternoon, Nasa, and to your viewers. Really a tale of 2 halves from Mr. Price. We've seen the earnings, as you mentioned already, down 6%. But if you look at their second half earnings, they were down quite heavily at almost 15%, with sales slipping from a run rate of going down 3% overall, but the second half was down by over 6%. So it's really a tale of weak consumer where disposable income is under pressure, and also the impact of load shedding, as you already mentioned. I thought an interesting stat from Mr. Price was that stores which had backup generators were able to have 5% more sales than those without backup generators. So that just shows that staying open is a big factor for retail businesses to be able to attract the footfall, as you would expect. And in the case of Mr. Price, from now on, they've said that all their stores have backup power. So that means that that should help somehow offset some of the effect of load shedding.
Speaking of the effects of load shedding, we got a 9-month update from Growthpoint indicating that they spent 87 million rand on diesel. That share price just moments before I spoke to you, down about 3%. What was the key takeaway when we look at that update from Growthpoint?
Yes, again, not a very encouraging update. Vacancies are ticking up. It was below 10% in the first half and now just over 10%. Reversions, which means basically how they are renegotiating their leases, these are down. So they're basically having to reprice down their leases down 14%. I mean, that was slightly better than what they've seen the first half. You mentioned the cost of load shedding, so that's adding to cost. So your revenue line with vacancies and reversions under pressure, the costs are going up. They are trying to dispose of non-core properties. That's positive. And then the other positive is the fact that they're seeing, especially in their V&A property, quite a big increase in footfall, 23% year on year as tourists return to South Africa. But yeah, I mean, it's again a story of SA Inc. and the fact that it's proving very challenging for the leading listed property company.
Staying with the theme of SA Inc., we had Standard Bank release their trading update as well as First Rand yesterday. What are the key themes, or I suppose the common thread running between these two financial institutions so far?
Yeah, both updates, especially Standard Bank's very strong guidance with earnings likely to be up well up into the 20%. First Rand also guiding that they've had very strong performance and returns going to be above the 21% that was being expected. So I think the themes of bad debts are being well contained below their long-term target range. Retail being under pressure, as you would expect, but advances growth being quite strong. So we've seen in the case of Standard Bank, the vehicle finance advances growth really strong. Fees and commission, which is linked to the retail businesses in both cases, also quite strong. And then in the case, which is very peculiar to Standard Bank, the Africa operations benefiting from quite a big reduction in bad debts, which will help the earnings there in the rest of Africa. So the banks, contrasting with the retailers, seem to be weathering the storm well, but that's because during COVID, they took quite hefty provisions, which they are now able to release, which is helping. And then advances growth, demand for loans being quite strong, especially from the retail side. And the rest of Africa, in the case of Standard Bank, also doing well.
Let's talk market specifics right now. What do you make of market sentiment right now that we've had day one of Jerome Powell's testimony indicating that perhaps we may have to see rates staying higher?
Yeah, I think you are right. The world is on central bank watch. I think if you look at market participants, up until recently, there was an expectation that the Federal Reserve would cut rates as early as November. That's been pushed out now. And I think Fed Chair Jerome Powell is at great pains in his testimony yesterday overnight, stressing the fact that he's not done with interest rate hikes, and maybe he would need another 2 hikes in order to make sure that inflation in the U.S. gets within the 2% range. So we're now seeing inflation, interest rates in the U.S. at 5 and 5.25. That could go as high as 5.5 to 5.6, which would have been a pretty hefty rate hike cycle, which means that markets are concerned that in its effort to fight inflation, the U.S. economy could dive into quite a sharp recession.
And before I let you go, just quickly, what do you make of this debate or with regards to central banks trying to balance growth with fighting inflation?
Yeah, I think the problem, and if we focus on the U.S., the U.S. is in a strange place in the sense of its labor market is still very strong, and the economy hasn't really weakened substantially until recently. The problem is that the impact of interest rates, as given that it's increased so much, tends to be quite delayed. So the risk is that the Fed is looking in the rearview mirror and keeps on trying to fight inflation and causing a lot of damage to the economy. So the concern is going forward, they would have gone too far. So the hope initially, Nastasia, was that we were done and the Fed had paused and we would kind of see how things evolve. The concern now is they might come up with 2 more hikes, which causes a US and even a global recession.
Patrice, thank you so much for your time this afternoon. That is Patrice Raso, the Chief Investment Officer at Ashburton Investments. We're going to take a quick break. When we come back, we'll have more news for you, so stay tuned.